Hello, economics students. I believe in our last lesson we finished with this slide that has this picture here, which is actually of the Federal Reserve headquarters in Washington, D.C. And as you may recall, it is the Fed which is in charge of monetary policy. Monetary policy, again, is controlling unemployment and inflation by managing the supply of money. In other words, you could say monetary policy is how the Fed manages economic growth through managing the money supply. So let's take a look at the different ways that the Fed does this. They actually have several different strategies that they can utilize to manage our money supply. So let's take a look and see how they do that. First of all, the Fed can change the bank reserve requirements. Remember, when you deposit money in the bank can lend that money out to others, but they must keep a certain amount of that money in reserve, so there will be cash available to those who want to withdraw their money out of the bank. The greater the reserve requirement, that is, the more that the Fed requires banks to hold in reserve, the slower the growth of the money supply. And we have an equation here that I want you to make note of, the money multiplier. This is the rate at which banks can lend excess reserves to increase the money supply. And that money multiplier then is shown with the equation that you have there. You take the size of a deposit, divide it by the reserve requirement, which is expressed in percentages, and you will get how much money can be created from a single deposit. Okay, so here's a graph that's kind of interesting. Let's say that the reserve requirement is 10%. So for every loan, or excuse me, for every deposit you make, the bank must hold 10% of that in reserve. Look what happens to the value of that deposit. That is, look what happens to the amount of money that will be created from your deposit if the money reserve requirement is 10%. Assume that you deposit $100. At a 10% reserve requirement, your $100 is going to grow, and eventually that line, if we continue it, it will eventually reach $1,000. At a 10% reserve requirement, your deposit of $100 will eventually create $1,000. And you can see the other other possibilities here as well. At a 20% reserve requirement, you deposit $100. Eventually, your $100 deposit will result in $500 of new money. So as you see, the higher the reserve requirement, the lower the amount of new money that will be created. The lower the reserve requirement, the greater amount of new money that can be created. So if the Fed wishes, for example, to allow more money to be created, then they will lower the reserve requirement, and the result will be more loans being made and therefore more money being created. Another tool that the Fed has is a change in the discount rate of interest. Okay, the discount rate. That's the rate of interest that the Fed charges to banks. For example, if a bank finds that it's running low on reserves, it might have to take a loan. Believe it or not, banks do take loans just as individuals and other businesses do. But when a bank has to take out a loan, they have to go to the Federal Reserve. And the Federal Reserve, just like any other bank, will charge an interest rate. So that interest rate that the Fed charges to other banks is called the discount rate of interest. So how would an increase in interest rates affect the money supply? Well, think about it. If you decrease the interest rate, that means it will be easier for banks to take loans from the Fed. Therefore, banks will be able to increase the amount of cash that they have on hand through a loan from the Fed, and they can lend that cash out. Now, why would a bank do that? Well, the discount rate of interest will be lower than the rate of interest that the bank will charge to its customers. So the bank will make money by taking a loan out from the Fed and then re-lending that money out to other consumers or businesses at a higher interest rate. So another way that the Fed can manage money is through something called open market operations, and that's the buying and selling of government bonds. Okay, now recall, we've talked about bonds a little bit in class. A bond is basically debt. And as you probably know, the United States is always in a budget deficit these days, which means that we're actually spending more money. The government is spending more money than it's taking in taxes. So how do we finance then that budget deficit? The government will sell bonds. And you might have bonds yourself in the form of savings bonds. Okay, a savings bond is government debt. If you own a savings bond, the government owes you money. So just like any other debt, a bond will pay interest, and a lot of bonds are owned by banks. Okay, in fact, banks are the biggest owner of government bonds, and the reason for that is banks want to do that because it's a very safe investment for the bank. The government is not going to default on its loan, so the banks are willing to buy bonds and make some interest. Foreign governments buy bonds as well. A lot of governments have been willing to help finance the United States budget deficit. Governments overseas will buy American bonds. It's a safe investment. Okay, so banks buy the bonds and they receive interest income from the government, and this will take money out of the bank reserves. Think about it. How's the bank going to buy those bonds? It's going to take cash that it has in reserves, okay, and it will buy the bond. Now, the bank cannot lend out a bond, okay? It can only lend out cash that's held in reserve. So when the bank buys a bond, that will lower the amount of the reserves that the bank has. That means that the bank will not be able to lend as much money, and that will slow down the growth of the money supply. Now, sometimes the Fed will choose to buy bonds back from the bank. Okay, so when the Fed does that, what happens is the Fed hands a bank a bunch of cash, and in return, the bank gives the Fed the bond. Now the bank has cash instead of a bond, and the bank can now lend that money out and create money into the economy. They can lend out the cash that they have and create money. So when the banks buy bonds, that lowers the money supply. When the banks sell bonds to the Fed, that will increase the money supply. We'll get into that a little bit more in a minute. The last way that the Fed can create money or manipulate the money supply is twice a month they will auction off reserves to banks that want to lend more. That's called the term auction facility. So if a bank wishes to have greater amount of cash on hand that they can lend out, they can actually buy additional reserves from the Fed twice a month. So of these tools, which one do you think the Fed uses the most to greatest impact? Well, the answer may surprise you. It's actually, open market operations. Okay, and the one that is used the least is the one we just talked about, the term auction facility. So I have a graph here, a table here, and I'm not even putting the term auction facility on here because it's relatively minor. But I want us to understand how these different strategies are going to affect the money supply. So reserve requirement. If we are in a recession, meaning that there's high unemployment and the economy is really doing badly, for the reserve requirement, the Federal Reserve is going to lower the size of the reserve requirement for banks. So in this little table here, you want to have 3 columns and 4 rows. And over here in the top row, you're going to put recession. Over here, inflation. And for reserve requirement in a recession, the Fed will lower the reserve requirement. In a period of inflation, when we have too much money being created, the Fed is going to raise the reserve requirement. So fill out this table. Recession, lower. You might have just an arrow pointing down. Inflation, in a recession, lower the reserve requirement. And in inflation, raise the reserve requirement. Okay. Discount rate of interest. In a recession, you want to lower the interest rate, so have an arrow pointing down. In a period of inflation, you want to increase the discount rate of interest. That will slow down the increase in money supply, and that should slow down inflation, as we saw on the supply and demand graphs earlier. Open market operations. In a recession, the Fed is going to want to buy bonds from banks, buy bonds, In a period of inflation, the Fed is going to sell bonds to banks. So in a recession, by buying bonds, the Fed is increasing the cash reserves of banks by taking the bonds away and exchanging them for cash. In a period of inflation, the Fed is going to sell bonds, and that means that the banks will be handing the Fed cash and getting a bond in return. And of course, the banks cannot lend out a bond, so that will lower the money supply. So make sure you get this graph down good. I think that will help you in the future. One thing that might surprise you, let's go back real quickly to the reserve requirements. In the Great Recession of 2008 and 2009, the problem was that there was not enough money in the economy. Something like $1 trillion was lost as a result of that recession in 2008, 2009. So the Fed took very aggressive actions to increase the money supply to help pull us out of that recession. They did a whole lot of buying bonds in the open market operations. They bought billions and billions and billions of dollars worth of bonds to increase the cash available to banks. And the reserve requirement, though, in most instances for most banks, the reserve requirement was actually lowered to zero. And that still exists today. Most banks have a zero reserve requirement today, which means that they can lend out basically everything. Now, banks are wise. They're not stupid. They're not going to just completely eliminate their reserves. They know they need to hold some in reserve. They know they need to hold some cash in reserve. But basically, there's no rule that says they have to. So to help keep the economy going after that 2008-2009 recession, reserve requirements were virtually eliminated, which is a pretty fascinating thing, and that still is the case today except for the very largest banks. So with that, we're going to stop this presentation, and you'll, as usual, want to check Canvas to see what's going on there. Have a great day.